Hey everyone, welcome back to Corporate Decoder. Today, Viskase Holdings Incorporated just filed a Form 8K detailing an amendment to their credit agreement, and it tells us something important about their financial strategy. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing might seem like just a loan update, but it actually reveals a shift in how Viskase is managing its debt and operations. Viskase Holdings Incorporated, a company primarily involved in packaging, has just amended its credit agreement. Think of a credit agreement as the rulebook for a company's loans. What has happened here is they signed a 7th amendment to a credit agreement that originally started back in October 2020. This means they've gone back to their lenders multiple times to adjust the terms of their borrowing. This particular amendment involves Viskase Companies LLC, which is a wholly owned part of Viskase Holdings Incorporated. So, what are the big changes? First, the deadline for them to pay back this loan, the maturity date, has been pushed back by a full year, from August 2026 to August 2027. This gives them more breathing room to manage their finances instead of having to focus on a near-term debt repayment. It's like getting an extension on a big bill. However, this extra time comes at a cost. The interest rates on their loans are going up. For things like revolving loans, which are flexible loans they can draw from and repay, the interest rate is increasing. For loans tied to the SOFR benchmark, it is going from 3.0% to 4.0%. For other types of term loans, it is also ticking up. This means Viskase will be paying more in interest over time, which eats into their profits. Another key change is how they calculate something called consolidated EBITDA. EBITDA is a way to measure a company's profitability before things like interest, taxes, depreciation, and amortization are taken out. By changing how they calculate this, Viskase is likely adjusting for certain costs related to restructuring or other big deals they're involved in. This can make their reported profitability look better by excluding certain expenses. They've also changed the rules about what kind of business operations they're allowed to sell off. Specifically, they can now sell certain equipment and property related to their Osceola facility and their Chicago property. This suggests Viskase might be streamlining its operations or selling off assets it no longer needs, which could be a way to raise cash or focus on core business areas. Now, this loan is backed by almost all of the company's assets, excluding real estate. This is pretty common for these types of agreements. If Viskase were to default on this loan, the lenders could potentially seize a lot of the company's assets. This highlights the importance of these credit agreements to the company's overall financial health. The filing also points to Exhibit 10.1, which is the actual 7th Amendment document itself. While we do not have the full details of the omitted exhibits here, the summary provided gives us the main takeaways. The report itself is dated the 21st of April 2026, although the event it's reporting on, the amendment to the credit agreement, happened on the 16th of April 2026. This little time difference is standard for these filings, giving the company time to prepare the official report after the event. What does all this mean for Viskase Holdings Incorporated? Well, pushing out the debt maturity date is a tactical move to buy time. However, the increased interest rates mean they'll be spending more on financing in the coming years. The changes to EBITDA calculations and permitted asset sales suggest they might be in a phase of restructuring or strategic shifts, possibly to improve operational efficiency or cash flow. The fact that they're amending the credit agreement for the 7th time also suggests a history of adjustments and perhaps a need to continually adapt their financial structure. Historically, companies that repeatedly amend their credit agreements might be facing ongoing financial pressures or are actively managing significant operational changes. This pattern can sometimes precede more significant financial maneuvers. For Viskase, the big story here is a renewed focus on managing their debt obligations while potentially divesting certain assets. The increased cost of borrowing is a clear signal of higher interest rate environments or a perceived increase in risk by the lenders. Meanwhile, the flexibility to sell specific assets could be a strategic move to deleverage or reinvest in core areas. The long-term impact will depend on how effectively they use this extended runway and whether the asset sales generate significant value. It shows they are actively working to manage their financial position, which is a good sign. But the increased cost of debt is a definite headwind. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.